Hey everyone, this is Rob Keens of goldsilverpros.com. It is Thursday, April 29th, 2021, and today I have a very special presentation for you today. A lot of my subscribers have been pinging me and bugging me and emailing me to write about the uranium sector, and I've kind of held off because I have looked at the uranium sector before. I covered it when I used to write for the online financial publication Seeking Alpha, but I feel as though now is the time to go ahead and introduce this to you guys because I think the fundamentals in uranium are getting stronger. And while we are Gold Silver Pros, we do cover other areas of the investment world as well. For example, if you're a subscriber and you go to Gold Silver Pros University, we cover the general economy, the general stock market, as well as real estate. So we do like to cover other areas and provide potential values for you. So we are going to grant the wishes of many of my subscribers, and we're going to get into uranium. I'm going to start by talking about the overall fundamentals. I'm going to give you a nice OECD report from 2020 that gives us the short and long-term picture. We're going to talk about uranium price fundamentals, and then I'm going to offer you an opportunity of a company that I'm bringing to the channel that I think is very unique in the space and different from the rest, and you'll see why here in a moment. So let's go ahead and get into the presentation. I'm going to go ahead and share screen, and we're going to start off with a chart of uranium. So this is a uranium chart, long-term 1990 2021, as you can see here on Trading Economics. And they track the OTC and the futures price here in this chart. And you'll notice a couple of interesting things about this chart. We saw a low uranium prices up until the early 2000s, and then it spiked here in July of 2007, I'm sorry. It came down and then it spiked back up again the beginning of January 2011. I'm going to explain what those spikes are with a little bit of data here, and then we're going to talk about the fundamentals of uranium now. Here's where we are in price. But where do we think that price is going to go? So when the uranium price spiked up the first time on this chart in this time frame, it was June, July of 07. Uranium spiked up because there were expected resources to come on and a very big project that didn't come on. There was a flooding at a mine. Those resources got delayed. It took a long time for that mine to get drained. The uranium price had already started to rise. You can see it rising 2005. All the way up until this point, 2006, 2007, when that event happened. And then that's when it spiked. So uranium was already on an uptrend due to world demand. Then you had that potential supply coming on that people expected to meet it, and that didn't happen. So here is a nice reference at uraniumseek.com from Andrew Mickey, Chief Investment Strategist, published back on August 22nd, 2008. And it goes on to document what happened. It was a flooding at one of the mines for Cameco. The world's largest uranium producer, Cameco, was banking on pumping out uranium from its Cigar Lake mine, and that was the only way for it to capitalize on rising uranium prices. That's an important point we'll get here in just a moment. Cigar Lake was going to be massive, and the mine was expected to provide as much as 17% of the world's yearly uranium production. However, a retaining wall collapsed and the entire mine flooded. Cameco confirmed a single pound uranium wouldn't come out of Cigar Lake for at least 5 years. And so that caused the bubble to continue to grow. What was a small bubble we see here at the beginning of this uranium uptrend turned into this major bubble here. And eventually they got that sorted out. According to World Nuclear News, 12th of February 2010, Cameco had completed the draining of the Cigar Lake. So that took a couple of years for that to occur. And then that's what we see on the price chart. Price starts to come down at the very beginning of 2011 and so on and so forth. So the market was reacting to that. So now we have the other price spike to explain what happened here at January 2011, December 2010, when we saw that other high in the uranium price, and that is explained through this report from the OECD, Uranium 2011. I'm not going to read the whole report for you. It is long. As you can see here, it's 489 pages. But I did read through this report, and the reason the price was spiking in 2011 was due to both an increase in demand for uranium and increasing costs for getting it out of the ground. I'm not going to go over all the details of why it increased in cost, but it was increasing in cost. And when you have demand going up and an increase in cost in getting uranium out of the ground, that's what causes uranium price to go up, and that's a natural market. So both of these were natural market events. This was a short-term event that occurred over a couple of years for expected uranium production from a Cameco, Cigar Lake. And then you saw the spike here in 2010 due to increases in prices and increases in demand. At that time, as a lot of reactors were being built and nuclear reactors are being built and the demand for uranium had gone up. So that explains those fundamentals. Now we're going to get into a little bit of a longer term over why I think uranium is in a bull market right now and why it's potentially a really good investment. And then we're going to talk about the company I want to bring to you today, which is really safe and great way to leverage that. So in this OECD report, Uranium 2020, Resources, Production, and Demand, we have a few charts that I want to show you guys. So we're going to start here on page 17 with known resources. And we're just going to outline resources, supply, and demand, and where that's expected to go in this report. So as we get down here to page 17, I want to show you what it looks like. So get one page up, and that's the chart we're looking at. If we go up here, it is the distribution of reasonably assured resources among countries with a significant share of resources. So long term, this is the countries that are involved in what their resources are at the different grades. So you can see the grades here in the upper right-hand corner. They're color-coded, and then you can see who has them. Now, that doesn't mean that that's near-term production. That's the reasonably assured resources, what we think we have available in the ground that we can get in a reasonable time frame. That's a very important chart because that tells us what we have in the near to the medium term without making some additional discoveries. So that outlines for you what it looks like across the world and which countries have those. Now we're going to jet down to page 39 here, and we're going to look at another chart. And on 39, we have this really nice chart in trends in exploration and development expenditures. This is very key to the argument about why uranium may be getting more expensive and the price may be going up. And we did see on the chart, as we go back over here, we did see a nice little rise in the price of uranium since 2016 from about 20. It touched on about 32 at its high, and it's trading about the 28, 29 range. And the reason is because preceding that, at about 2014, you had the domestic and the non-domestic at the same time, exploration and development expenditures fall. Well, why was that? It's a combination of demand and supply and how much uranium we need. And so there was some needed supply destruction or stopping of mining activities because there wasn't enough demand to keep that price up. The price had come below the cost to mine the uranium. And so you had supply destruction. You had people just closing the mines temporarily and not spending on additional exploration and development, and you saw this come down. So this is important because this trend has been going on since 2014 through 2019 here on the chart from the OECD, which means we had not been producing enough uranium for future demand, fast forward today in 2021. So that was a natural effect of the market, demand destruction short term. But what that meant was leading into 2020, 2021, with the increased demand for uranium, we didn't have enough supply because they had stopped producing for those reasons. So now we're going to go to page 57, and we're going to look at another chart here from the OECD, and we're going to see uranium production. So you can see the production and who produces it. 41% Kazakhstan, 13% Canada, 12% Australia, 10% Namibia. Now, Australia has the biggest reserves, but they're not, again, producing all those reserves. So again, when we're looking at actually who's producing versus reserves, just because they have a lot of reserves doesn't mean they're actually putting out all those reserves. There needs to be an incentive for them to do that. There needs to be the appropriate price point for them to restart the mines and get that production out. And so that tells you that Kazakhstan is producing a lot, but Australia is going to have to step up when the new demand comes, and other countries as well. And that production is not online. So for those of you looking at the supply demand side, when you're prospecting for your investments, this tells you that while there is supply there, it's not readily available at this particular moment. And as we have demand, that price is going to come up to meet that demand. That's basic economics 101, if you will. Then we're going to go to page 71. And there's an interesting thing in this report from the OECD on page 71, and this is idled mines. So I wanted to show you the idled mines chart. These are the mines since 2013 through 2018 that have been idled. So when we saw that chart earlier in the presentation about the supply destruction because of the price demand fundamentals, these are the mines that basically had been idled at that period of time. Now, can they come back on? Sure, they can. There's going to be expenditures in restarting those, hiring people, getting the mines running. It's not going to happen right away. So there's going to be that period of time which you have the increased demand, and then you have to restart some of these mines. And some of these companies may not be ready to restart their mines. It depends upon their individual financial situations and characteristics of those. So you can't expect all of these to just come right back on and reboot and push the Staples easy button and get that production out. So again, that's where I think that we have a short-term opportunity, and then there's a longer-term opportunity, which we're going to show you here in a moment. We're going to go to page 77 now, and we're going to look at world installed nuclear capacity. For those of you that want to know what that was, as of the 1st of January 2019, it was 396. I believe that's gigawatt net. In North America has the most installed, 114. Then you have, European Union, 117 the most. Then North America, 114. Then East Asia, 106. Then non-EU Europe, 44, Middle East, so on and so forth. So that's the overall installed capacity. So that's would be who would use that nuclear capacity. So for those of you stateside that are wondering, does the US use a lot of nuclear energy? The answer is yes. They're second in the world. European Union's not the only one. We're almost caught up to the European Union, at least as of January 1, 2019, the latest available stats from the OECD. And then, of course, you got East Asia. And then you got non-EU Europe, which some Eastern European and other countries. And then you got the Middle East and so on and so forth. And the one here I want you to really pay attention to, if African economies ever really get to that point in which they're building a middle class, some of them already are, but I mean, as a continent as a whole, this number could really explode and the demand for nuclear energy will go up. That's more of the medium to long term, but I did want to point that out. That is definitely a possibility for those of you looking more long term, although probably not in the next few years. So now we want to go to something environmental. What is the case for nuclear from an environmental perspective? A lot of people think nuclear is dirty energy, but here there is a chart on cumulative CO2 emissions avoided by nuclear power in selected countries from 1971 to 2018. So we know that the largest users of nuclear are United States and European Union, and because they're the largest users, you see the most carbon emissions saved. So if you're in particular concerned about carbon emissions and all the law that goes around that in terms of making your investment decisions, then here is a nice little chart that shows you if those countries' policymakers are wanting to go green, uranium is a good way to do it because it reduces cumulative CO2 emissions over other sources of fuel, especially the fossil fuels. All right, so I wanted to show you that chart. That is if you're in the green movement and that is important to you, and certainly even if it's not, but it's important to the politicians in your countries, or if you're just looking at the demand profile for nuclear because you know these politicians want what they consider green energy, that chart is an important factor in making your decision. Okay, we're going to go on to the next one. Projected nuclear installed capacity here on the next page on 91. So we'll go to page 91. Here's the installed nuclear generating capacity world total. And you can see that it's been a nice increase, expected increase to 2040. So they're expecting in 2020 to be 387 world total. As you look down here, they're expecting by 2040 this to go to 626, and it's steadily rising. So the low and the high for 2020 is 387 to 402. But as you get up into 2025, 2030, 2035, long term, they know, OECD knows you can't replace all the energy generated by nuclear given fossil fuels and other fuel sources, especially solar and wind. It just does not produce as much energy as nuclear. And that's why over the longer term, again, we're expecting the demand for nuclear to continue to go up. Okay, a couple more charts here. We're going to look at a world uranium chart. Let's look here on page 96. We're looking at annual uranium production and requirements. One of the reasons price is going up and why we expect it to continue to go up is because world production, this dark blue line, has fallen, but the world requirements has gone up. So there was a period of time in which uranium price had fallen, that 2013, 2015 range, when you saw that supply destruction. And what's going to happen is now you have supply demand. So you're going to have supply coming back online. In the meantime, while it's coming back online, you're going to have higher prices. Why? Because the world requirements in 2019 have gone up, but the capacity to produce it has not yet been brought online. Why? Well, that's what I said earlier. It takes time to do that. And each individual company has to make their individual decision based upon the economics of their deposit, how much money they have, the investors that they have, and so on and so forth. So what we want to do is find a way to play this market that takes advantage of the price increases without exposing us to any individual company's individual financial and economic situation. And that's key to the company I'm going to be talking to you about here in a moment, because I found a way to do that for you guys. And I think it's a safer and a better way in the long term with higher returns. One last chart here from the OECD, and you can see cumulative uranium production and requirements has gone up from 1949 to 2019. This is a long-term, what is that, about a 70-year chart. So not only did it go up from 1949 to 2019, but they're projecting out it to go out to 2040. And again, that's because they know, the researchers know, and the policymakers know, we haven't found a way to replace that energy. It also replaces a lot of CO2. So if you've got requirements to reduce CO2 because of climate treaties and things like that, and you need to replace energy that solar and wind can't, and we're harder to find the easy to find oil and gas, you've got to come up with a way. And uranium really is the best answer for a lot of people. That's why I expect uranium to continue to be demanded more. All right, so now we've gone through that report. We've gone through all the charts from the OECD. You've got the short, medium, and long-term demand and supply, and we know that the price is going to go up. So how do we play this? Rob, how do we play this without exposing ourselves to any one individual company's individual situation in a way that's safe, but gives us leverage to the actual uranium price? And I'm going to show you that. So the company that I want to bring you is Uranium Royalty Corp. Now, remember from earlier in the week, we talked about gold and silver, and we talked about Sailfish Royalty and gold and silver because they are a royalty company, a good way to play gold and silver more safely if you don't want to go research all these individual companies, but you still want exposure. Well, for the first time in uranium, we have a royalty corp taking advantage of that same model that you see in the precious and the base metals that allows you to get exposure to uranium without necessarily being exposed to all the operating conditions around all of those individual companies. So Uranium Royalty Corp trades on the TSX Venture Exchange under URC and under the NASDAQ under UROY. So if you're in the US, you can get them on the NASDAQ, the Toronto Stock Exchange in Canada, URC, and those are the tickers there for you. Now let's get into the advantages of this company. We're going to spend some time doing that. So I want to talk about management and directors. Mir Adnani, many of you know from the uranium sector, director of Uranium Energy. Let's expand out his profile, Uranium Energy Corp. Now, I know them because I have met them at conferences. I first met their company at Vancouver Resource Investment Conference in Vancouver a few years ago, talked with their management. And this company, the one that he runs, Uranium Energy Corp, has assets in Texas where I live. So I was very interested in that because I was interested in local resources for uranium. So I followed Amir for a long time. He speaks on the concert circuit. He's very successful. He's chairman and director of a company, very, very well known. You have Scott Melby, the chief executive officer, president, and director. He has been a director of the company since April 2017, chief executive officer and president of the company since October 2019. He's very experienced, 35 years experience in nuclear energy industry, leadership positions in various uranium mining companies. So you're already talking about a company which has major leadership that has done this before, has the experience. He was previously as a vice president of commercial at Uranium Participation Corporation, chairman of Kazatomprom, national uranium company in Kazakhstan. Remember, they produce a lot of the world's uranium. So this guy knows the uranium market around the world. Now, if you're going to run a royalty company, you want somebody who understands uranium company around the world. That management is so key, and they've got it in Scott. They've got other people here that you can look through, if you will. David Newberger, Veena Patel, Neil Gregson, very, very experienced in finance, in uranium, in mining, in this sector. A very, very experienced team. I wanted to highlight that. The team matters. If you guys go to Gold Silver Pros University, if you're a paid subscriber on my website and you go through the mining stocks section, I have a whole article on how to value companies, and management is my number one factor over success of the company. And this team has it in spades. They have the managers that you want. First thing I look at, pass this with an A+, just in my opinion. They do have analyst coverage. I want to point that out. So this is a well-to-do company that is covered by analysts in the market. This is not a small company, which is just getting their feet underneath them. They have coverage and they've been successful. They have a nice share price, and they're being covered by Canaccord. They're being covered by H.C. Wainwright & Co., by Paradigm Capital. So if you are on the buy side and you want to go read those reports, I'm sure that those financial institutions will have reports for you, but it's good just to know if you're an investor that it's covered by these major institutions. And Canaccord, H.C. Wainwright, and Paradigm are major institutions that you would see following. This is kind of rare sometimes in the resource space because overall resource companies are kind of small when you compare them to a company like the tech giant. But to see a company that has this amount of coverage and those professional reports being written for the market is good. It means that you're more likely to get a supported share price, interest and liquidity in the stock, and so on and so forth, and available information about what's going on that'll hit the market. All right, so we're going to go to their corporate presentation. I'm going to walk you through this. Uranium Royalty Corp, their tagline is proven team, proven approach. I agree with them, and we're just going to walk through. Again, reminder about their tickers, UROY on the NASDAQ and URC under the Toronto Stock Exchange Venture. All right, so investment highlights, first chart, the first mover advantage. URC is the first company to apply the successful royalty and streaming business model to the uranium sector exclusively. It's not just that they have exposure to uranium, it's that they're focused on uranium. Focusing your attention on one sector is good. And when you have that management we went through that has experience, that's good. Strong balance sheet, so they can capitalize on additional royalty and streaming acquisition opportunities, so they can continue to be picky about what they want and add to it in an accretive fashion without taking on additional dilution or debt. Physical uranium ownership. They have 5.9% stake in London listed Yellowcake PLC, which hold interest in physical uranium. So they're buying uranium at the lows. So they also have exposure to the end product, not just the companies producing it, but to the end product. So as that uranium price rises, because that demand profile is very bullish, as I showed you, and the overall state of the uranium market at the beginning of this video, they're going to make money on the actual uranium itself, which is really cool. They've got direct exposure to the commodity. They include interest on 15 development, advanced, permitted, and past producing projects in multiple jurisdictions, MacArthur River, Cigar Lake Mines, and when we're talking the big ones. And the management and board possess decades of uranium industry experience. So that's what you have there. Again, a slide in here for you on the board of directors and management. Excellent management team, not an issue there. They have a strategic partner in Uranium Energy Corp, as I stated, which Amir Adnani has been involved with for many years, and which I have followed for several years, looking at them as a potential investment since about 2018 and early 2019. Here's their capitalization. They only have about 72.2 million shares outstanding, which is not bad. If you consider the warrants, it's diluted about 99.7. The key shareholders are Uranium Energy Corp, Altius, Mega, Marin Katusa, KCR Fund, Rick Rule, Sprott Global, Commodity Capital, and Extract Capital. So when you see Rick Rule, Sprott Global, Marin Katusa, those are major names in the resource space, major names. If you want to know the biggest proponent of uranium probably on the planet, it may be Marin Katusa. Just go to one of his conferences or sign up for his newsletter. He puts out reports all the time on where uranium is going, and he believes he has the best companies to invest in the uranium space. And guess what? He's a major shareholder of this one. So those are major endorsements by people who know what they're doing, put millions and millions and millions of dollars down, and don't play games. They know how to prospect these companies. The market cap right now is 271 million. For those of you wanting the financial numbers, I'm trading on the NASDAQ at $3.01 as the time of this presentation, 375. I think it was a little bit higher when we actually looked at it earlier. So this is a little bit old. They've actually had a little bit of share price appreciation since this presentation was put out. They have 46 million in cash and securities, 7.5 million in shares in Yellowcake PLC, which has that exposure to the physical uranium. So financially, they're pretty darn sound. They're not in any sort of dire straits. They've got liquidity. They've got exposure to the commodity. They can capitalize on a lot of these things. So going through, they want to do access to multiple countries. So we showed that chart on the state of the uranium market earlier in this video, where I talked about where it comes from. They're in where it comes from, those major jurisdictions. So they're taking on projects that are in places where you're going to get the uranium. And that's what you want from a royalty company, because you want production, and you want production over time. So that's their strategy. Range of market capitalization, near, medium, and long-term assets. That's what you want. They don't want you don't want to be invested in mines that are going to deplete quickly, because that share price will fall. You want that steady stream of oncoming production and solid production. And that's where you get the benefits out of a royalty or a stream. Either way, invest across the cost curve and physical ownership. So they have all of those things. That's their diversified approach. These are the names that they're involved with: Uranium Energy Corp, Cameco, Orano, Rio Tinto, Yellowcake PLC, CNNP, Paladin, Electricity de France, Energy Fuels, Peninsula Energy, Azarga, and Laramide Resources. So some major names there that people will recognize who are in the resource space. So again, strong partnerships, strong projects, checks the box. I'm just going right down and checking all the box on what you want to do. Now, if you're, again, a paid subscriber, Gold Silver Pros University, I'm checking all the boxes that I tell you to look for when you're prospecting for companies. This company checks the box, and that's why I'm bringing it to you today. I believe that this company checks all those boxes and is a positive potential investment for you. Now, you have to do your own due diligence and research. We're just a research firm here to educate you. But again, I do see a lot of those things that I look for. And I think if you do your own research, you'll see them as well. So they have a global diversified asset portfolio. You can see that here on this map. They're in the world-class Athabasca Basin royalties with MacArthur River. They have Cigar Lake Waterbury, Rough Rider. So you can see what they have and their different royalties and streams here. 1.7 NSR over here, 1% GOR on a 9% share, 20% MPI on 3.75% share. They give you all the details there. Continue Russell Lake, Diabase. So they're going through all that. They're going through all the properties here that they have. So they've got a wealth of properties in different areas, and this is really what you want. They go through the detail. I'm just going to fast forward through some of this. Really, really good profile. So why do you want to own a royalty company? Let's go back to what we were talking about earlier in the week. Because you're not exposed to the operational issues of the individual miners. You're basically taking a portion of their profits and exposure to what they produce, but you're stretching it across many providers. So you're not exposed to any individual providers, potential operational issues or jurisdictional issues. You're well diversified, but in that industry. And so Uranium Royalty Corp gives you exposure to the price, fixed operating costs, no development or sustaining capital costs, no dilution when they're funding a company. So they're non-dilutive to the actual mining company. So it helps all those mining companies get non-dilutive capital to help those mining companies raise funds, benefit their shareholders, and produce. So it's a win-win for both the mining company and for the royalty company. That's something I wanted to point out. A lot of times people are like, why would a mining company want to do a royalty or stream? Because it's non-dilutive financing in many cases, and it's more readily available funds. And the management of the royalty company can value it much easier than can a collection of analysts all over the place when they're trying to raise funds. And it's easier, quicker, and better sometimes to get that to fund your operations. Exploration and expansion upside without associated costs, meaning the way that you set up the royalty and stream is as they increase production, you get the benefit of that, but you're not paying the operation cost to do the drilling, the exploration of all these individual mining companies. Diversified asset portfolio and ability to grow without increased management. The great thing about these royalty companies, and Frank Holmes of US Global Investors has said this for years. We wrote together on Seeking Alpha. I followed him and I've talked to him at conferences. And he's a big proponent of royalty companies because you know, per employee, they make a lot of money because it doesn't take a lot of people to run this. It's basically a financing operation. It's not a mining operation. So they bring in the mining expertise, the exploration expertise on the team. They identify the good projects, but they just do the financing piece. So you don't have to have a large organization to do that. That's one of the advantages of having a royalty company there, is to have that small team have those larger profits. Those profits then can be passed on to shareholders. And that's why royalty companies over time often return more, in some cases, than individual miners, depending upon the miners that you're looking at. So they have a great strategy here. They had their own uranium market overview, which I'm just going to point a couple of things out. Nuclear power growth remains robust. There's 443 operable reactors worldwide, 54 additional units under construction, 54 new reactors connected since 2012, and a 2.6% compound annual growth rate. Nuclear growth expected 2027. And that comes from the global nuclear power industry. Now, I showed you the OECD report, which showed much more robust top-end potential growth in uranium all the way into 2040, uranium demand 2040. A couple of key points here. China announced it's likely to triple nuclear power capacity by 2030. India plans for 21 new power reactors by 2031. United Arab Emirates completed a reactor and 3 under construction and 4 more under consideration. UK updating their nuclear fleet to new advanced reactors that can produce more energy, therefore will need more uranium. Russia is building 36 reactors in China, India, Bangladesh, Turkey, Egypt, Iran, and so on and so forth, all over the place. Japan has 33 reactors, energy plan targeting 22% nuclear power. Nuclear deemed essential to the net zero target by 2050. So again, when you get to net zero carbon emissions, that's where nuclear comes in. Japan's right there. That's why I showed you in the OECD report the benefits of running nuclear and the reduction of carbon, and why policymakers are going to turn to uranium. And that's confirmed here in this report. Of course, the U.S. is completing 2 new reactors in Georgia, has maintained a 20% market share for 30 years, and so on and so forth. 32 new reactors demand expected as electricity demand grew 36% from 1989 to 2019. So again, a good reason to want to get into uranium. Reactor demand significantly exceeds primary production, spot prices below production costs, hedges falling off. 2020 demand expected 175 million pounds. 2021 production expected only 128. So that is a production gap or a supply deficit of about 47 million pounds. So if we go back to why the uranium price is going to rise, if we get back to, well, I don't have that chart up, but I showed you the chart where they had more demand than supply, and that's why this price is going to go up. Last time that happened, last time you had more demand than supply, it went up. And we're not talking about the issue with the Kamiko mine. We're just talking about more supply and demand here, more than supply and demand here. And look at what happened. We have the exact same setup. We now have more demand than supply. We're expecting this to continue to go up. So the uranium price is going to go up, make it more profitable. Again, that's confirmed in their presentation. Uranium spot price here, as you can see, peaked at 138. Financial crisis, $70. Now it's down at 28.78. It's going to go up. Okay, that's the spot daily. It's going to go up again. We showed you all the reasons for that in the previous presentation. Accelerated rebalancing, cuts exhaustion, reduction suspension, mine curtailments, depletion, all of that had been occurring. Now we're reversing that whole trend. We're reversing that supply depletion that we had. Beyond existing mines, TradeTech's market appetite for new production, very bullish. Look at this from TradeTech. Again, another confirming resource. The OECD, International Uranium, and now TradeTech, both all saying the same thing. 3 confirming sources saying the same thing. Additional demand, expected price to rise. So we're doing our research here. We're not trying to build out a theory or give you the investment profile of something that could go either way. Everybody pretty much in this industry expects this to go up. And so that's why this royalty company is formed. And that's why it's been operating the last couple of years, acquiring assets, trying to build out that uranium capacity. And so that's what's happening. They don't have a lot of shares. They operate very financially efficient. They have exposure to the rising prices of uranium under these very safe agreements in which they don't get exposure to the actual potential operating issues that you may have at a mine, which is an advantage for royalty companies. And they're very profitable for the investors because a lot more of that income passes down into to the investors in terms of the valuation of the company, the share price, and potentially they'll do some distributions as well in terms of dividends. We'll see what happens there, but your royalty companies do very well. And so I expect a royalty company in a market like uranium, which is expected to increase, is going to do very well. And I think that outlines the investment profile for you and the potential of this company. Once again, we're going to show you what that company is. I'm going to go back to the ticker so that you guys can see that. It is Uranium Royalty Corp. Again, URC is the ticker on the Toronto Stock Exchange Venture. And on NASDAQ, it is UROY. I'm going to be taking a look at this one myself. I've been following uranium for a few years, waited to present it to you guys, even though a lot of you guys had just been pinging me constantly. I have a friend that pings me on Telegram on the phone all the time, who's one of my subscribers, is like, Rob, talk about uranium. I'm like, I'm not ready. I'm not ready. Well, now we have the fundamentals lining up. We have a good company, good management, good projects, okay, a good model in the royalty model. And in addition, we have a macro environment in which uranium price should be rising. So again, I wanted to bring you guys an investment opportunity. I've chosen them to sponsor us on the channel for that reason, because I believe in their story. And I wanted to bring that opportunity to you guys as well. That's going to wrap it up for today, guys. That is Uranium Story. And that is Uranium Company, in which I would opt to play the uranium story. Until next time, this is Rob Kientz with goldsilverpros.com.